From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Well, let's take a look at where we're at and likely to finish for Friday and for the week, of course, at or near record highs. So the CBO 200 up 1/3%. And taking a look at the ASX, peaking just after 11 this morning Eastern at 8,565, which was a new record. Currently just off that. We're up 1/3% for the day and currently up almost 1.5% over the course of the week. So just taking a look at what is moving, I guess the themes of the day and, well, really for the month. January jump, that's where we've gone. Certainly on equities this month has been a good start to the year. Gold glitters, the gold price hitting another record overnight, and as a result we have seen all the goldies move very positively today. And rates interest, well, lots of interest over interest rates, certainly with the prospects of a rate cut in February appearing to firm. That, of course, is off the back of that this week's read from the December quarter on inflation, which is moving in the right direction. So many economists now calling the RBA and a rate cut next month. Quick check of the sectors then that are moving. Let's get into that, see what we're seeing across the board today. As you'd expect, mostly higher, although, well, the REITs certainly among them. And Goodman Group, a standout there. That, of course, after it was sold off heavily early in the week in the wake of the DeepSeek emergence there and the impact, or potentially, on data centres. Elsewhere, taking a look in the mining space, I was mentioning how well the goldies are doing today. BHP is also higher, although Rio and Fortescue have come off. South 32, another mover. Mineral Resources continue to feel some pain, particularly after updating the market. And mentioning the goldies there, Newmont, probably the pick of the bunch. It is up more than 3.5%. And the utilities, Origin out with an update today. Market taking a negative view of what they're seeing there at the moment, off more than 5.5%. AGL also down. Catching up with the top stories of the day, ResMed posting a 10% jump in revenue for the second quarter to $1.3 billion US. Chief Executive Mick Farrell saying the company is well positioned to capitalise on what he calls once-in-a-generation opportunities relating to consumer wearables that track sleep health. Elsewhere, Ramsay Health Care Group Chief Executive Carmen Monaghan is retiring after 27 years with the company. Origin Energy forecasting lower LNG production in 2025 in the range of between 670 to 690 petajoules. And Strike Energy receiving $162 million in credit from Macquarie Bank to refinance the company's existing debt. And also Lendlease, they're offloading Capella Capital to the Japanese trading company for $235 million. Furthers the company's efforts to simplify the group and reduce future funding requirements. All right, let's unpack the week now. No man better to do that than Shane Oliver from AMP. Shane, welcome back. Good to see you. Let's first start what we're seeing in equities at the moment. Another record locally, reflecting, I guess, what we're seeing more globally at the moment. What do you see driving particularly the local market? Clearly investors were buoyed by that inflation number and the prospect of a rate cut. Is there more to it?
Look, I think that's the main factor. If you think about the global situation this week, we saw Europe go to a record high, and guess what? We saw the ECB cut rates again, and they were dovish. It's basically the same story in Australia. We haven't seen the rate cuts yet, but I think we're getting to that point, and that has buoyed our market, even though the US share market so far this week is actually down slightly on the back of those deep concerns in relation to AI and tech. But that is the main factor. Don't forget, we did have a fairly rough December, so there's a bit of a catch-up there. But by the same token, the fact that we've been able to go to a record high, I'd have to say is a positive sign. The market is starting to discount that lower rates are coming. The market a week ago was saying 75% chance of a cut in February. Now it's over 90%. a week ago, less than 3 cuts this year. Now it's pushing towards 4 cuts this year as priced into market. So all of those things are certainly helping. You could also point to the so-called January barometer, which looks at the month of January and tries to project forward what that means for the year. And it does give you some rough guide, because January is traditionally a seasonally strong month. If it's strong, that's normally good. In fact, 85% of the time in the US since 1980, you get a positive January, you go into a positive year. In Australia, it's 76% of the time you get a positive January, go on to a positive year. So far, our market is up more than 4% if we close at this level, or close to it. It's going to mean a positive January barometer, which augurs well for the year as a whole. Doesn't mean you won't have corrections. I think we certainly will, but it is a positive sign.
Well, of course, we saw a mini correction, if you like, certainly with tech stocks this week, Shane, with DeepSeek calling ructions, creating ructions in the market. What did you make of that and the fallout, I guess? Questions now been asked, I guess, into the veracity of DeepSeek and what they claim. But I guess more broadly, if you're looking at perhaps cheaper prices, what that's going to do, particularly with those AI-related tech stocks, and questions, of course, of just how much CapEx is being spent at the moment.
Well, that's right. Sorry, I got something stuck there. I think it's an incredibly positive development, not necessarily for Nvidia and hardware tech stocks associated with AI, but for the rest of us, it is a very positive development. I guess there's all sorts of questions, as you say, around DeepSeek. I mean, the evidence does suggest that its app can do what it claims to do. Most rankings that I've seen see it just below ChatGPT, and we're talking about a score out of 100. It's not, one's 99 and the other one's 98.5 or something like that. So in terms of its usability and performance, it does very well. I have heard that it doesn't like answering questions on China. I think someone asked it, what happened in Tiananmen Square in 1989. It didn't want to answer that one, but I haven't tried it myself. But the real debate is around whether it's been able to achieve its outcome at the very low cost, less than $10 million versus hundreds of millions or billions of dollars for the US-related developments. So that is the big issue there, and obviously ongoing debate about that. But if they're anywhere close to it in terms of a fraction of the costs, that has huge implications. It's going to spread the use of AI through economies around the world a lot faster. If a Chinese company can do it, then other companies can do it. It means that AI is on the process to being commoditized, much like flat screen TVs. You think 20 years ago they were incredibly expensive. Now they're ubiquitous because virtually everyone can get one because of competition and innovation brought the cost down. Same with AI. That means less electricity demand. So big question marks around US tech in relation to this at a time where its valuations are sort of pushing tech boom levels of 2000, where tech share of the US share market is around record highs. Similar story as a global share. So that obviously does pose some vulnerabilities. But by the same token, if it benefits other parts of the market, then that could be a big positive. You can also make an argument, I think, as the CEO from Microsoft did. I think they called it Jevons paradox. If the cost of AI goes down, then maybe we don't need all those high-end chips. But by the same token, it spreads through the economy a lot faster, and it does still mean massive demand for software. It's a bit like flat screen TVs. The cost came down, but the demand for all the stuff that went into them exploded.
Yep.
So tech would still benefit from that in that sense. But the other issue is, what does it mean for investors? To me, this just highlights the danger in picking one stock. A lot of people love Nvidia and still on board, or one sector. I think it just highlights the importance of having a well-diversified portfolio, because trying to time any correction in this sector, and we know there will be one eventually, I think is going to be incredibly difficult.
Shane, let's turn to the economy, specifically interest rates. Now, of course, central banks, we've seen, the Fed remained on hold, already has begun its cutting cycle though. This week we had the Bank of Canada, the ECB, Sweden's central bank, all cutting. The Bank of England expected to cut again next week. What though for the RBA? Is there now a compelling case for the RBA to cut?
Well, I think the case to cut here is overwhelming. I mean, there was some argument by some economists that our story is different, that we've got chronically higher inflation. Anyone who looks at a chart of core inflation or trim mean for Australia and core in the other countries can see they're pretty much in line. And when you assess it relative to objective, which is 2.5% in Australia versus 2% in other countries, we're actually doing about the same as a lot of other countries that have now cut their interest rates below levels that you see in Australia. Likewise, the jobs market. You can make an argument, well, 4% unemployment, that's very low, so maybe we need to wait longer. But by the same token, why would you wait any longer? Because that 4% unemployment rate is not causing a wages breakout or excessive wages growth, so that's not a problem. Some say, well, what about the Aussie dollar? It's fallen. It sure has. It's very weak, but on a trade-weighted basis, it's in the range that's been in for the last 4 years, so big deal. So to be honest with you, I think the case is now overwhelming. It's going to be very hard for the RBA to just leave rates where they are, particularly when you trim mean. The focus trim mean, it came in 0.2% less than expected, 0.5% in the quarter. On an annualised basis, that's 2%. For the last 6 months, it's 2.7%. If you look at the monthly trim mean for December, it had another leg down to 2.7%. All of these things, I think, are indicating that we are getting inflation under control, and it's time to relax the pressure on the brake. This is not to say mission accomplished, that prices have gone back to where they were 3 years ago or 4 years ago. I don't think they will, but that's a totally different story to getting inflation back under control.
Shane, great to get across it. We'll see, of course, how that all transpires in a couple of weeks' time. Thanks so much for joining us on AMP. Have a great weekend.
You too. Thanks, Andrew.
Let's now get to our stock of the day. It was ResMed after it updated the market. Luke Winchester from Merewether Capital and Richard Hemming from Under the Radar Report with their analysis.
Gross margins were an issue for this business. They fell into the low 50s, 52, 53% for a period there. But this latest report, they're right back up into the high 50s, 50, 58, close to 59%. Revenue still growing at that steady 10% clip. So you're seeing some nice accretion to the bottom line. And I tend to agree with Mick. Look, the GLP-1s, is that a long-term, the effect of ResMed? I'm not quite sure.
This is a stock for long-term holders. It's a blue chip kind of company, but I would just struggle to justify paying 5 times sales, 20 plus PE, at least 20 PE. Like with the guy, what the guy was saying was, we've got some big capex coming ahead of us. Like, these technology companies are spending more and more to stay in business, and I think that's been a trend.
All right, let's catch up with the winners and losers in today's trade as we approach the end of the session. And no surprise that the gold miners, among them, Vault Minerals, the best. They're up more than 8%. Also, the uranium miners making a big comeback after being sold off heavily earlier in the week in the wake of DeepSeek. And Sandfire also on that list. On the negative side, just checking the bottom 5, if you will, Magellan down 8%. Origin, after its update, Credit Corp updated the market yesterday. It's also come off. Liontown being hit along with Nickel Industries. Checking what is on ahead for the week, next week that is, retail sales, December trade figures. That'll be another interesting data point for the RBA to consider. Overseas, we do get the jobs reading. In fact, it's Jobs Week in the US. Also, monthly household spending in Australia, a lot with international goods trades, and that important point for the US there, the US non-farm payrolls for January. Let's recap where we've been, finishing at a high. In fact, the SIBO up almost 0.5%. Taking a look at the ASX, making a comeback late in the session to also be up 0.5%, I should say, at 8,536 in fact. That is the COB. Thanks for watching and listening. And of course, we'll do it all again next week. Stay with us for the last call.